Hello, my name's Adrian Boothie. In this video, we're going to take a look at margin and leverage. It's a very important area of Forex trading or any type of derivative trading, whether it's spread betting, CFDs or anything, just to get a handle on how much risk you're actually engaging in. It's one of those things that we call a bit of a double-edged sword, really. The leverage is great because it allows us to use our money a little bit better in a way, a little bit smarter, but as long as it's done with a controlled way and a controlled attitude to risk. But let's get a look into it, and let's give you an example of something actually we're all pretty familiar with. You see, the problem with words like margin and leverage, it all sounds a little bit confusing. A lot of people thinking, God, I don't even know what any of that means. So clearly, trading FX is not going to be familiar. But actually, margin and leverage are really things that we're very familiar with. Look at this house here. A lot of people own their own house, and we have a mortgage, don't we? And I like to liken margin and leverage to deposit and a mortgage there. It's something that people are very familiar with, with buying a house and what's required there. But of course, everyone gets a little bit cross-eyed when it comes to trading and their attitude to risk. Using leverage is not risky if you're doing it the right way, but we're going to get into that in a second. So just having a look at here, let's assume we buy a house. Let's keep it down to that simple analogy, really. So we're going to buy a house for £100,000, and we go to our mortgage broker, and they say, right, in order to get a mortgage, you need to put up a deposit. That deposit, in other words, your margin requirement, is £10,000. That's what you need in your account. That's what you need to put up in order to buy that house. So in other words, you're getting financing for the rest. You're going to get a mortgage for that amount outstanding. And it's a kind of a similar process here, really, when it comes to trading. Here, in this case with the house, putting up a £10,000 deposit for a £100,000 purchase, effectively, we're getting 10-to-1 leverage on our trading. Leverage, whatever you want to call it. So we are engaging in with that, and we are used to doing it. It's fairly common practice in day-to-day life. So what does that mean to you? Well, using leverage means that we can have our 10% deposit, our £10,000. Not many people can buy a house for cash, though. So what it does is it allows us to use our money better by seeking financing on the overnight roll. But let's have a look at some of the basics here, really. So the house prices rise by 10%. That's great. Suddenly, our house value goes up to £110,000. So what does that mean to me? It means that I've made a profit of £10,000 on my transaction, or actually 100% on the deal, right? Because remember, my margin requirement was only £10,000. So if I was trading fully geared, really leveraged up to the hilt, then actually I'll be in a position where with my £10,000 initial investment, I've actually made £10,000 of profit, or 100% return on my capital. Of course, this is excluding any of the costs that there may be. But it's interesting to look at it in that way, particularly since we are used to such leverage and margin in our day-to-day life. So 10-to-1, that's the sort of thing you might get with a CFD or a spread bet when you might be trading shares in that way. Generally, the leverage you can get is a lot higher when it comes to foreign exchange. But it's important to bear in mind that just because you can get extreme leverage doesn't mean that you should actually use it. Just because you can buy £100,000 of shares with £10,000 on your account doesn't mean you should. In fact, it could potentially be quite foolhardy. And also, you may not necessarily want the mortgage for the biggest amount you could possibly buy and get. It may not be prudent to do so. So let's just consider foreign exchange. There's my double-edged sword at the bottom there. So Forex margins can be often 100-to-1 or 200-to-1. So what does that mean? It means that with £1,000, you can buy £100,000 worth of US dollars. So with 100-to-1 leverage on your account, with £1,000 margin requirement, £1,000 on your account, you have the opportunity with most FX brokers to buy £100,000 worth of US dollars. That's quite a lot, isn't it, with £1,000? So it means, of course, that we can go a little bit crazy with our trading account. But the problem is that, sure, the price could rise by 1%, because only a 1% margin. So if the market goes up 1% in our favor, sure, we're going to double our money. But if the price falls by 1%, it means that all of our money is gone. And these are the dangers really of using leverage without having the right attitude to risk. Okay, just like if your house price fell from 100,000 down to 90,000, effectively that's all your capital gone. So it's a very attractive way of us being able to use our money better, but it does come with risks, and it's all about making sure we're risk managing our account a lot better. And that comes down to your strategy, really. Our recommendation is that you don't risk more than 1%, certainly no more than 2% of your capital or your trading account capital in any one particular transaction. So otherwise, you're more likely to be engaging in too much risk, and also emotionally in too much risk as well there. So that gives you a rough idea about what margin really and leverage is. So margin is the amount of money you have to put up in your account. Leverage is the amount of buying power you're potentially given. Let's have a look at a trading platform now, and we can perhaps see it a little bit more practically. I've got a few positions on just for messing around really on this demo account here with FXCM. What we can see is positions here on sterling New Zealand dollar and euro dollar. Doesn't really matter what they are, it's just to give us a basic idea. So we've done £100,000 or 100,000 of each of them, and it gives us an idea about to the right our margin requirement. So that's our used margin for each of those transactions. Okay, so it gives you an idea about the amount of money that is required in order to put up a trade. If I click on the buy button against the market here, so this is, well, let's look at a foreign exchange pair. Let's look at the euro. So here we're going to do 100,000. Let's try a different amount. Let's try 10,000. So we're going to do 10,000 euro dollar. That's the margin requirement, is just £90. So you can see the idea of the very small margin, even though we're buying 10,000 worth. So it's important to get a handle on how much buying power you're getting. The important point being, this is just a demo account. It's annoying the way it does that, isn't it? The important point being, just because we can buy 10,000 doesn't mean we necessarily have to. So it's always about using leverage that you're happy with. The point being, have a look at what your stop loss distance is, and make sure the distance between your entry and your stop, i.e. your real risk on the trade, is an amount of money that you're comfortable with and in keeping with a good solid risk management strategy to your trading account. As I say, we typically recommend 1 or 2% risk of your trading account on each transaction. No more than that, really. So when we look at the account button with those positions on, let's just cancel this for now. We can get an idea about what our used margin is there and our usable margin there. So it gives us an idea about what we've got left to play around with. And of course, as that area gets down towards zero, then your broker is going to start contacting you about margin calls, maybe starting to close out those positions that you might have open. So it's important to manage that. Realistically, if you're managing your account properly, if you're engaging in the right level of risk for your trading accounts per trade, then you should never get anywhere near your margin requirement. Okay, you should never get forced out of trades, because you should be risk managing your account properly. This is the point. The reason why a lot of retail traders lose is because they trade and they engage in far too much risk for their trading account, which encourages emotional trading and encourages you to get banged out of trades far too quickly as those emotions start to take control. So an important consideration there, but there you go. That's a rough idea about leverage and also margin as well.